So as I mentioned, we're going to cover 4 topics. The first one around investment execution, the second around the business of advice, the third around communication and advocacy, and the fourth around compliance.
Well, speed of execution was paramount, and holding discretion via managed accounts enabled this. March 2020 was one of the fastest bear markets in history, but has also been followed by one of the fastest recoveries in history. So cost of delayed implementation would have been significant. I think the ability to make proactive changes to protect capital and at the same time provide timely communication to advisors and in turn their investors helps take the pressure off those advisors, because clients can see there's action being taken to defend their portfolios. And on the other side of that, I think importantly, having discretion also provided the opportunity to rebuild exposures progressively as the outlook improved. And it's often this decision that's the hardest. Look, retail investors and advisors will find it easy to sell. There's usually something big to worry about, as there was during March with the COVID outbreak. But often it's sort of more difficult to re-enter the market because the best time to buy is when things look the worst. So under the discretion of a managed account, the ability to incrementally rebuild your exposure as the outlook improves and enables you to participate in the recovery. And we think both sides of the equation really made a difference this year.
Yeah, thanks, Tom. I mean, this cost of delay that you mentioned, I think this is a point that's going to continue to come up. As you say, it was a rebound that sort of came and went, and the ability to actually execute on any changes, if indeed an investment committee could even meet. Now, Anika, from an advice business, I might ask you also to comment just on that execution. You've moved from a model of model portfolios to having central execution through a managed account, through an SMA structure. The roles and responsibilities of the investment manager running a managed account are still there. They're just very different. Appreciate your comments on that execution element of running an SMA.
Yeah, I think in terms of the traditional model whereby everyone was beholden to the old ROA process and clients got executed at different times, I think that managed accounts provide a great solution in terms of that speed of execution. We experienced a situation at the end of March, as everyone did, where our growth and defensive targets were really quite out of weight given the sell-off, and that provided an opportunity to consistently rebalance across the board. But given Zenith's had that delegation, they were able to get in at the end of March and provide a fast rebalance across all of those client accounts. So a really good outcome for clients from that perspective.
And just on changes to defensive asset classes, for example, and I think that's a point well made. Mark from Elston, do you have any examples of how you repositioned your portfolios, either your multi-asset or your Australian equities portfolios, where speed was going to be critical?
We actually came into the whole COVID-19 drawdown overweight defensive assets. We'd spent the last 12 months slightly sort of taking risk off the table. And so we used that opportunity, particularly with some good quality businesses pricing quite favourably, to reweight that back to more of a neutral position. And we're able to do that through the managed account structure. A couple of points I would make, which even at a real basic level, if you think about a balanced 50-50 portfolio, just being able to move back into that 50-50 allocation, given the markets came off 35% and then jumped 30%, that alone added about 2% over that month, just having that discipline. And I think, as Tom sort of touched on as well, it takes a lot of the emotion out of it, having that discipline of the managed account structure to be able to do that. So it is very tangible. And talking to advisors around the country, we are starting to, hear that there is almost two camps, between that divide of businesses still stuck in the old ROA structure where they weren't able to move versus those who adopted the new managed account format.
The second topic is really around the business of advice, and the two perspectives I'd like to put to the group here, each for your individual comment. The first one is, if you didn't have an instrument such as an MDA or an SMA issued through an RE to execute, then what would be the impact is the first part. But the second part is, what does it actually mean from your business's point of view, and are you aligned to best practice if you're not responding with your best ideas for all of your clients?
I find myself musing these days that if someone was starting an advisory business today and you said, here's a methodology you can employ when you make an investment decision, it might take you somewhere between 4 to 12 weeks to get implemented. It's going to cost you, if you've got a couple of hundred clients, probably $25,000, $30,000 to execute that. That you get the lags in performance that come with it, or you can have a methodology where you make a decision, it's executed within days, and it's cost neutral to your practice. You don't pay anything extra whether you make a decision to implement something different or not. If you presented those two cases to people starting a practice, I don't think anybody would choose the existing way of running portfolios. It was of its time when there was no alternative, but when there is an alternative that is clearly a better method, I think the old method will be consigned to history and time, but not completely, because there are very high net worth people who are willing to pay for high levels of personalised service, and that will still be appropriate for them. But I think for the majority of other people, it's not, can I justify moving to a managed account? It's, can you justify staying where you are? Because, you look at the FCA obligations, for example, that standard 2 about, treating your clients, sort of fairly and equally. The inequality is baked in to the existing model. People, I don't think we can get away from that. So we are seeing quite a bit of inquiry from advisors these days who are quite concerned about their FCA obligations, and they're seeing managed accounts as a way of addressing that.
Really interested, Anika, in your view on client equality and how that is delivered through managed accounts.
It's a much more equitable outcome for clients relative to the traditional ROA model, and I think that it also brings a level of transparency for clients. We had a situation where, following the growth defensive mismatch at the end of March, where we had a rebalance in place, we then had a subsequent rebalance a week after that by one of BT's auto scan rebalances. And interestingly, a client sort of picked up, well, 2 weeks ago you're buying Australian equities, now you're trimming at the margin these Australian equities funds, what's going on there? So I think, yes, there's an equity element to it. I also think that there's a really useful transparency element for clients that they wouldn't necessarily get in a multi-asset, multi-manager fund solution as well. So an interesting piece of feedback from the client that they really appreciated that transparency.
I'll ask a question to Tom and to Mark, because you also have private client boutique businesses as well as asset consulting, asset management businesses. And drawing on Brett's point before around high net worth needs versus call it more mass affluent needs potentially, how do you see that divergence playing out? Tom, perhaps to you first.
Well, I think it sort of plays for the very high net worth. I mean, we have a handful of quite sophisticated family offices that invest in our portfolios, and really they view it as the core, liquid, relatively stable component of their portfolio. Often they've got substantial real estate portfolios or interests in private businesses or assets, which have a very different risk profile to what we do. And so certainly in that high net worth or family office space, there's still a need for having a managed account even as a core solution as part of that portfolio.
And Mark, any comments from Elston's point of view?
Yeah, I'd agree. We do run IMAs as well as SMAs, but we actually have the same portfolio across the two. So whether it's a client with 10 mil versus a client with 200,000, it is the core of their portfolio. Obviously, the high net worth clients will have assets outside of that model, but we sort of view it as, again, a real core for each of the client, regardless of whether they're high net worth or retail.
I wouldn't mind adding to that. I think it's a good point you make, Mark. Is our view is that asset allocation is a systematic exercise and advice is personalised. And as you say, no matter what the profile of the underlying client, once they've got a particular set of risk or return objectives, then the optimal asset allocation applies evenly to them, whether they're investing $100,000 or $10 million, and managed accounts enable that to be delivered across various different client bases equitably.
Now, Andrew from Quilla, might ask you first just to comment on the investment committee process and that framework that you referenced earlier, and how that then flows through to advice practices, then ultimately to their clients.
So we need to we have an internal meeting here at Quilla. We decide that something needs to be changed in our clients' portfolios. We'll put together a communication to the investment committee to explain what that change is. We'll meet with the investment committee, phone or face-to-face when you can, and discuss that. The committee will make the recommendation, and then Quilla will provide a brief communication so that those advisors can then distribute that to their clients. And that happens all within a 48-hour period, but it also happens concurrently, in that the clients will see a change in their portfolios at the same time as they're receiving communication from their advisors on why that change is occurring. That makes our job as an investment consultant a whole lot easier, but it also means the advisors, by utilising a managed account structure, have confidence that the message their clients are receiving are consistent with the changes that are happening in their portfolios. And this is one of the problems that's occurred historically, is that advisors might have been running a model portfolio and sourcing research from the various products that were in their model portfolios. But no one had the top-down view across that portfolio, and no one was able to provide that. So advisors typically would have provided research from one of the investments in their portfolio, which might not have aligned with the overall messaging and the overall positioning of their portfolios. So it's a much more consistent approach now. Advisors know that every bit of communication their clients are getting is going to be consistent with the actual portfolio positioning and the changes that are being implemented in their portfolios.
On the method of communication itself, Mark, I'm aware that Elston use SMS technology to advisors to say, and that's probably more around the Aussie security selection rather than the multi-asset. But how have you used technology to communicate in real time changes within your portfolios, Mark?
That there are real benefits that we know for clients with managed accounts around transparency, but it is a double-edged sword. One of the benefits of that transparency, or one of the challenge, is clients can see everything, and advisors are at the coalface effectively defending the decision of that portfolio manager. So we've taken the view that we need to equip advisors to be able to have those investment conversations. And echoing Tom's point, it is a collaborative effort. So our job is to really pump up their tyres and give them the tools to be able to do that. And one of the ways is we actually send a text message and an email to advisors within 48 hours of investment decision with a short video. And that video will actually be from portfolio managers outlining the rationale for whether we purchase a security or purchase the fund, and also providing the tools then for them to communicate that to the end client. And I think a key point too is in terms of building trust with clients, if you're consistent with your approach and you tie that sort of investment decision back to the original investment philosophy, it's very important clients get that comfort and they understand, okay, well, Elston's doing what they said they were going to do. The investment decisions make sense. So I think that's a very critical part and one of the real benefits that the managed account structure enables advisors to really build trust with their end clients.
Thanks, Mark. And I think just on that same theme, Brett, you work with multiple asset consultants and investment managers, implementing through the MDA instrument. How do you, from a governance, from an investment governance point of view, see the timeliness of that communication, that consistency of information flowing, and any observations about, what you consider to be best practice?
I mean, firstly, I think what we saw in March and April is you get this massive spike in how important communication is to people. Like, in a routine sense, people say, oh, yeah, there's a change happening in my portfolio. That's nice. But when anxiety amongst investors goes through the roof, all of a sudden, the advisor's caught just on the phone all day. They talk themselves hoarse for weeks on end. And you haven't really got time to be sitting down and trying to empty your mind and think clearly about how you're going to communicate. So knowing that the portfolio manager's doing that in a dispassionate way and that they are generating a high quality of communication at the time you most need it is really important. And I think in a practical sense, when investors, shoot themselves in the foot, it can be when they do get stressed and they feel that they're sort of triggered to action. So the good communication is going to really help settle people down. I can see there's a steady hand on the wheel. Actually hearing it through a video is brilliant. Like Mark just described, I think, just hearing someone's voice that, hey, we're not worried, we're okay, this is what we're doing. It's reassuring. I think that's enormously beneficial, because otherwise people can turn temporary losses into permanent ones. And when we're doing due diligence on consultants, we effectively have three major headings. One's the asset allocation, one's the security selection, and the other one is communication. We sort of rate them as similarly important, because this is a service industry and we've got investors on the end of this who really need to be kept well informed. So it's that good, timely, concurrent communication, and that people are skilled at making it relevant to investors. And we know that advisors still tweak some of those communications a little bit where they find there's a bit too much jargon creeps in, but by and large, that this has been a huge aspect of the increasing importance and popularity of managed accounts. Just how that good quality communication, what a difference it makes to advice practices and investors.
So Kelly, you're dealing with clients on a daily basis. How's your communication, the cycle changed, the frequency changed over the last 3 months relative to the previous 12 months?
I think what we've seen in our business is our clients don't necessarily have a strong appetite for receiving highly technical information from us. We send out a monthly report to clients that basically shows their current asset position and some general market commentary, just to cut through the noise of what they're seeing on the news each night. Throughout COVID, we didn't change the frequency of that reporting, but we certainly changed the frequency of just keeping people calm and, sending out, information in different forums. So we had video links from our CEO, just, putting a face to the name and reassuring clients. The communications that we're receiving from the investment managers and asset managers throughout that period were really key to keeping us calm as advisors. So I was I shouldn't have been surprised, but I was surprised at the level of emails I was receiving from fund managers throughout Australia during the early stages of COVID. And the ones that I obviously looked to for sensibility were the ones that are the trusted ones that we're using in our business now. So that information became really, really important to understanding how all of, the main three that we currently use in the business, how they were tactically positioning themselves, because they were taking slightly different tactical positions. And that then made a difference to the conversations that we were having with clients as they rang up, based on what portfolio they were in, how it was likely to respond, and how it applied to their personal situation. So we don't tend to be completely broad-based in the way that we disseminate information. We still really need, through periods like COVID, to be tapping into the emotional drivers that are, causing people to put up their hand outside of the standard communication that we're sending out to them.
There is an increased cost to serve advice, to deliver advice, and there's a number of reasons driving that. And Many firms have been slowly unwinding legacy pricing arrangements and resegmenting their client base, and as part of this, outsourcing functions and services is a way to preserve profit and reduce the cost to serve, maintain margin, and therefore practice sustainability. How have managed accounts helped with the cost to serve? And I might start with Kelly from Legiro.
Probably one of the obvious trends in Legiro in recent times is the ability to reduce the advisor force, if you like. And I think some of that definitely would stem from the managed accounts being integrated into the service office. So at the moment, we have 3 key advisors at Legiro, and some of that has occurred through people choosing to leave the industry and not keep up with educational standards. Some's been about age and retiring. And what seems to have naturally happened is we've been able to transition to having less advisors and more administrative staff and potentially offshore administrative staff to support our processes. So, compliance costs are continuing to escalate. Certainly, that's not something that's going to change in the next few years. And I think a lot of practices through COVID have had to make some, belt-tightening decisions around how many advisors they have in the next few years in their own businesses. And, the advisor force is shrinking anyway. So I think one of the key issues that was raised earlier around that concept that you potentially have an advice practice with every advisor historically having their own preferred model portfolio or their preferred bent on what's the ideal outcome from a portfolio perspective for a client. And I think where managed accounts become really powerful is when the advisors in the practice come on board and believe that solution is actually providing those solid outcomes.
How are you using rebates and leveraging scale with managers in the Quilla business?
What I was saying is, with managed accounts, obviously advisors can, have segregation and specialisation of duties. They can engage third parties like Quilla, and we can provide them with all the tools that we've talked about to enhance the process. Same thing with Quilla is we can aggregate the amount of FUM that we have with particular underlying investment managers and directly negotiate rebates with those based on the aggregation of all the FUM that we bring to the table. So that's been a really beneficial thing for advisors to access discounted rates beyond what would be otherwise available to them through their platform, and then pass those rebates directly back to their clients. So that certainly helps offset the costs of engaging specialists like Quilla or like a managed account structure, and still you can provide a very cost-effective solution to the client. So I think as well, the compliance side of things, the use of digital tools and technology, Chris, just to sort of branch off a little bit on that, back to that original question, is going to improve that ability to serve clients. So, we're very keen to work with advisors to understand what their needs are around servicing clients, tie that in with a managed account structure, but then deliver as much as we can to make the process far easier for the advisors. And it's in everyone's interest to make that process streamlined. To that end, Quilla working with some software called Fincast to enable advisors to provide goal-based advice, but more importantly, to link that to one of the managed account strategies that the advisor has access to. And that really streamlines the initial engagement process for advisors and means that there's a direct link in that client's eyes, a direct link to their goals, and it showcases why that strategy is appropriate for them. So, yeah, I mean, I don't think, I think there's ways to solve some of these increased compliance costs, and I think having managed accounts and having a whole range of services that can address that is possible. will help support the adoption once that realisation comes through that this is an evolutionary step, not necessarily trying to revolutionise what advisors do.
Something like $900 billion out there in the world of platforms. Personally, I'll be very surprised if upwards of 70% of that doesn't end up in a managed account of some form, because I think the structure is just superior to the old advice models.
It's a win-win. I mean, clients end up with cheaper, hopefully better risk-adjusted portfolios over time, more transparency, more service. Advisors gain efficiency, better governance, and gives them time to focus on doing what they do best and giving good advice and service to their clients. And so the institutionalisation of this part of the market is really key.
Obvious great outcomes for investors and clients and advisors, but also for licensees and regulators. I think providing that institutional level of investment management, just removes a level of risk there, across dealer groups and across the industry as well.
There's also a strong service proposition around the adoption, development, execution of managed accounts.
It's a significant commitment from the business and one that we're continuing to invest in.
Thank you. Well, on behalf of BT, thank you everyone for your contribution this afternoon.